Welcome to StockOdds Odds and Podcast. I'm Dave Singh here with Rob Friesen. Happy New Year, Rob. How's everything?
Hey, Happy New Year to you. All right, things are
2023.
going along just smooth, and what could possibly go wrong in a brand new year, hey?
It has to be better than 2022.
So what are we expecting this year? So, well, first of all, let's talk about what we saw last year. Basically, just to sum it up in a nutshell, is defensive names took the leadership. Anything that didn't have earnings or earnings were way off in the future or was having serious decline of revenue or earnings or competition, anything that was sort of more discretionary, definitely underperformed relative to the defensive stocks. So it was a year that fundamentals did come back into play, and I think you remember us talking about that just after the beginning of the new year when I said, "Hey, looks like they're buying all the low PE multiples and selling all the high PE multiples," and that was really at the start of the year.
Yeah.
So that kind of persisted all year. I mean, there was names that you could have stayed short, essentially, if you could live through the volatility, because some of the rallies along through the year were quite powerful too, right? Like when you have a face ripper where you're up 3-4% in the day in a major index, I mean, it's pretty substantial. So, it's hard to sit through all of that, even though looking back and be like, why did you ever cover your shorts?
Yeah.
So, to finish off the year, how did things end? The NASDAQ was the worst performer, down 33.1%, right? And the Dow was down just over 8%. So quite a spread there, quite a difference, which leads me to some thoughts. So first we'll go through the seasonality of this week, and now that we're doing this a bit later, the futures are open, have been open for a while, and initially they opened up significantly, and then since then they pulled back a little bit and bounced off the lows. So it'll be interesting to see where things are trading in the morning, but it did seem that hey, it's a brand new year, let's party, and the futures were up already significantly when they opened. So where are they right now? Well, the Dow Jones futures are up 48 points, or 0.14. S&P's up 4.5 points, or 0.12%. NASDAQ is up 5.75, or 0.05%. And the Russell's up 8.6, or 0.49%. So it looks like the Russell has the leadership at the moment. And the VIX is up 0.10, or 0.44. So a little bit slightly defensive. Probably that started when we pulled back from our highs that the futures opened at. Looking at energy, crude is trading down slightly. It was up on Friday. It was quite a nice day for the crude area. And the metals, we're seeing that gold is up significant right now. We'll talk a little bit about that more after Dave's finished with some of the seasonality stuff. But gold is up 21 points now, or 1.15%. Silver's up 2.12%, or 0.51. Platinum up 1.79. Copper up 1.35%. And palladium down slightly. Copper showing a little bit more appetite there for, against the recession trade, a little bit more of reopening and especially with China coming back online more so. So, all right, give us a lay of the land for this week. We have a shortened week. It's compressed into 4 days. And the first 2 days are still kind of Santa Claus rally, potentially. The first 2 days of January are also part of that. So you never know if there's a bit of a risk appetite from that. But this is an interesting compression week of 4 days. So and ends in the first Friday of the month. So give us the lay of the land here.
Yeah. So first off, in January, the SPDR is expected to do plus 0.89%. And
that's for the whole month, right?
For the whole month. And the Q is a little bit better at plus 0.2%. So that's the backdrop for the whole month.
Yeah.
But for the first trading day, the SPDR is expected to be minus 0.16. Q's pretty much break even, plus 0.01. The Russell stocks, IWM, minus 0.40. So it's a little bit soft on that first day of the month. And within that, the sectors that are expected to do better or worse, gold, GDXJ 3.75% and GDX 2.93, silver 1.36%. So these are the strongest ETFs that to be longer. Also things like oil, the ARK-K funds, XLE, IBB, so a little bit of risk on there. And things to be shorter are XLU, which is minus 0.99%, IYR, which is real estate, minus 0.83%, XLP, XLI. So there's a bit of a risk appetite, but the gold and silver are expected to do much stronger on that first day. And on the first Friday, which it's a little bit better, the index SPDR is plus 0.38%, and the Q's plus 0.59%. So it's the first Friday is better than the first trading day of the month, and the sectors that are expected to do better are actually reversed. Gold is expected to be weak on that Friday, so gold stronger tomorrow, the first day, and weaker on the first Friday. And longer things that are risk on. A lot of the ARK funds, ARK-KK, ARK, the W, the G, XOP, QQQ, XLK, Biotechs, XBI, IBB. So a lot more risk appetite on that first Friday of the month rather than the first day of the month. So that's in terms of seasonality. And we have a couple economic reports trickling into. A lot of it's centered around manufacturing data. So on Tuesday, we have the S&P U.S. Manufacturing PMI report. On Wednesday, there's the ISM Manufacturing Index report, and also the FOMC minutes at 2 p.m. Eastern on Wednesday. Thursday, there's a little bit of employment data, ADP employment report, and initial jobless claims. And on Friday, non-farm payrolls, and unemployment rate, and ISM services indexes. So some economic news in terms of manufacturing and employment you can be expected this week. It doesn't appear to be anything major. And there are
the minutes, the Fed minutes on Wednesday, that I could be a little bit of a wait and see, just because we like to kind of reanalyze what was said and how much emphasis is on what words. Do you know what I mean?
Yeah.
So Tuesday could be a bit of a wait and see regarding those minutes, right?
Yeah. And then on there's some earnings trickling in, but the most notable ones are on Thursday the 5th. We've got Walgreens, ConAgra, Constellation Brands. So some of the staple stocks, and so no big tech earnings per se, but there are some earnings trickling in the back. So if you are trading symbols, check their earnings to make sure.
For the month, while we're on the ETFs there, XLB for the month is supposed to be down minus 8.6, right? But yet gold is supposed to perform, quite well. I think it was GLD was 3.3% for the month. So that's an interesting situation when you have gold, which is part of the basic materials.
Mm-hmm.
So what I would do with that trade is kind of think about, what are some of the gold components, and I would look at what's in the senior minors versus what's in the junior minors and stuff. And just remember, people, that it can be very different for the granularity of day to day to day to day. So when we look at tomorrow and we say these, this is what's expected versus looking at the whole month. But there's a way to sort of position yourself that if something's expected to be really strong and you can get it at a discount one day, you may want to be involved in some pair trades or some swing trades, overnight for an extended period, or just look for a discount open and take it for the day potentially. So it's interesting to me that the XLB is soft for the month, but gold is strong for the month, and yet gold is one of the basic materials. Mm-hmm. So I would position myself by finding some of the best candidates in that group to be long, and short other things that are part of the basic materials. Basic materials is an interesting ETF anyway, because you got packaging in there and you got some weird stuff, right? So it's like, pull it out, look at it, and maybe you can make something happen. The other thing is the utilities. They're expected to be up 2.5% for the month. And financials are supposed to actually be down 0.24%. So they're always one that I keep an eye on in terms of that syncopation, the opposition, financials strong, utilities weak, or vice versa. In this case, financials are supposed to be weak for the month and utilities very strong for the month. And so you can do the same thing with, like, for example, the Dow is supposed to be only up 0.23% for the month, but the Qs, as Dave mentioned, up 2%. So, and that's interesting because if technology gets a bite, if we get any risk on and appetite at all, you already have your playbook. This is helping you with your playbook. The monthly backdrop, and then any indication of risk on for a particular day, you kind of can trust it because people will scramble to participate, right? So one of the scenarios that I would run for what could happen here is, because the Qs have been down 33% last year, we look for things that are distorted or completely discounted ahead of a seasonality window. So if our seasonality is saying that Qs should perform well, and they're coming into that window extremely discounted, I would probably lean more towards that than I would the talking heads that disagree with it. And what could happen this month is, let's just say that we have a robust mid-month seasonality. Okay, maybe this week is kind of rocky or whatever, but maybe we get some traction mid-month, because the way that generally usually goes is that mid-month is stronger, and then third Friday is not too bad, and then the last trading day of the month is a bit softer, along with the last week. So, but what I could see happening is that maybe we get some traction in risk on, and then we get this situation where everybody thinks that they're going to miss the party and they really buy, and you get this FOMO. And then you go into February, and all of a sudden it's like after everybody's rebought stuff, we've had the tax loss selling guys, they've rebought in January. Everybody else is kind of coming in and they're buying. And we get this situation where everybody's, fear of missing out. They finally buy. And then in February, it's like the rug gets pulled out again, and we go down to test our lows. Maybe the the October low or the June low are two areas which I would focus on, or worse. I mean, what are the ranges that you hear some of these analysts talking about? I mean, $3,200. Yeah. What is the range?
3,200 on the low end, as high as 4,800 on the high end from end of next year. So it's a really broad range of.
Well, and we could, the funny thing is, we could hit both. We could actually go down and then we could go back up too, right?
Yeah.
But it wouldn't surprise me. But which happens first? I would think that at some point we're going to drop first. But it doesn't. People could be expecting it right away. They could be expecting, well, start of the year is going to be just the same as what we had last year, and we're going to continue to sell off because there's so much bad news. And it could surprise you that we could have a rally here in January.
Mm-hmm.
So I say that from the seasonality. I say that from the tax loss selling and then the rebuy. And I say that from people scramble when they start to see the market heading back up from these discounted levels. They're going to maybe dust off that combination to their cash locker and pull some cash out and put it in the market. It's possible. And you still got a lot of institutional cash out there too, because last year when the interest rates were going to rise, there was a lot of people taking money out of the market. There was a move to cash institutionally. Maybe on a retail level, people didn't know what to do and they sat in it too long, or maybe they started buying the dip and they got caught and then they, lost a lot of their working capital. But that's not necessarily true on an institutional level where there's cash that has been parked and waiting for a buy opportunity. So keep that in mind as one of the scenarios. The scenario would be a rally mid-month, even towards the end of the month, even overriding the month-end seasonality, which is supposed to be a bit softer. But let's say it continued as a rally. And then in February, the rug gets pulled out. That wouldn't surprise me at all.
And February is a pretty robust month too, normally. This is expected to be 1.08% for the month for Spider.
Yeah, it's supposed to be more than January. I'm just talking about if we get, instead of just 0.9 for the SPY for January, let's say we do 2%. Mm-hmm. Or let's say with maybe the SPY doesn't do as much as the NASDAQ. The NASDAQ's supposed to do 2%, right? But what if the NASDAQ does 3 or 3.5? And so some of the stuff that would normally happen in February gets compressed into January. Yeah. Now we're just speculating, but the funny thing is, what do we know? The market likes to factor in everything that it knows or can anticipate. It likes to surprise most of the people most of the time and prove most people wrong. Uh-huh. And from a seasonality perspective, we like to look for things that are at an anomaly going into a seasonality window. Well, there's nothing better than the Qs. If the Qs are down 33% for the year and now coming into the new year, and for the month of January, they're supposed to do 2%. Well, that's exactly what we talk about. I mean, we can't ignore the thing that we've talked about all the way through is look for discounts ahead of seasonal windows. Well, there's one for you, right? I can't ignore it. I have to run a scenario for it. I have to allow for it. So while I'm kind of more bearish as far as this year goes, just my own kind of I think there's a lot of stuff to deal with. This would be the surprise that would catch me. I would be leaning on the short side or kind of more negative, right, on this. And this would be what would catch me as a real ferocious rally. Uh-huh. And so what am I doing? I'm preparing myself for anything to happen, that it's okay no matter what the market wants to do, and I'm not going to get caught, right?
Yeah.
So no, I do think this year has a lot of surprises ahead. I think there's many more things that have to work themselves out. We have civil unrest globally. We have regimes that could potentially be toppled. We have it could be natural disasters, again, more than we've seen before. Could be wars break out in more places. Could be, we talk about gray swans. And what are gray swans? Gray swans are the things that we already can anticipate can assign a potential probability to, and they have a big impact even if they're low probability. So an example would be, it's a low probability that a nuclear activity happens in the Ukraine. Okay, it's you may have heard about it, you may have thought about it, you may be questioning it, but it's still probably a low probability. But if it did happen, it would be a big event, right?
Mhm.
The magnitude of it would be substantial. If North Korea does accidentally hit Japan, if they send something into Seoul, South Korea, and they accidentally hit something, it could be a big event, right?
Yeah.
So these are the gray swans. Gray swans are things that we can think about. They're things we can factor in and say, what would I do? How would I respond? What groups, what sectors would I press? Things like that. So anyway, this week here is important in that they talk about how the first 5 trading days of January goes. So goes the year. So there's a lot of pressure on these first 5 days, which 4 of them are in this week, and 1 of them is next week. But again, I mean, just because they say that, just because they anticipate that, doesn't mean that's how it's going to work out.
Mhm.
It's just a lot of pressure, and we've got analysts' activity is a little bit more meaningful. I think analysts are listened to and given a little bit more weight or respect than they would maybe in February or March, because it's the start of a year and we don't know. We're asking questions, we're looking to experts, and that doesn't mean Dave and I are leaning on every word of the analyst. It just means in general, people give a little bit more credence to what the analysts have to say. Right?
Yeah.
Energy, I'm looking at oil as still something that could potentially rally. The reason I say that is it depends on the US dollar. It has been declining. It may decline further, which may lift metals more. I like the gold trade continuing. I think that we saw last week some signs of it popping up, and already the futures here at the start of the year are already up. So I'm giving gold plenty of room to move to the upside. I would also do that with oil. European sanctions have gone in now, so they're not going to be buying any more Russian oil. We're talking about China, coming back online as they've downgraded the Omicron to a common cold now, and get on with your lives. So there's more opening up of the economy again. That means consumption could increase. We still have the recessionary implications, but I think there's enough to say that crude could try to climb back up a bit. So I'll give it plenty of room. What do you think about interest rates? Any comments there, Dave?
I mean, what's the 10-year right now? 10-year we've got at 3. Let's see. 10 years at 3.846, right? So it was up to 4.5. It went down quite a bit, but it's been rallying recently. So it's somewhere in between that last 3-4 month range.
Right.
And if that keeps ticking up, then it's going to put pressure on all that NASDAQ rally, right? So tech's going to be really tied to that.
I mean, it's kind of hit a point now where it could kind of go either way from where it is at the moment. So, how bonds and interest rates move from here is a bit of a guessing game, but we're not at an extreme. We've kind of settled in a little bit. Mm-hmm. So, be interesting. One thing that we should look at is the trading ranges here. We have on the SPY and the diamonds and the IWM, we have a 10-day trading range. I want you guys to really set your levels for the high from the 10 days and the low from the 10 days. The Qs doesn't share that. It has a 5-day high and low, but this IWM SPY and diamonds have the 10-day high low. Set your lines and really be disciplined to that. If we're still within it, it's going to be a chop fest back and forth, one day up, one day down. If we can break outside of that, then it has some legs to move either direction. And the bottom, if we look at going back on the monthly chart all the way back, we don't have any indication that in 2022 we really had a bottom, because we don't have any volume spikes like we have had in the past to indicate a bottom. You had a massive spike in 2020, 2018 as well in December. You had spikes all the way through, going back to 2008, 2010, even 2011. All those years of bottoms, they had massive volume spikes, but we did not have that in 2022. So that could mean that the bottom's not yet in. I wouldn't be surprised if we, at some point during this year, we find another big move down and we finally get some kind of a bottom. Okay.
Mm-hmm.
Hope that helps. Anything else?
No, that's it from here.
Economic reports we covered. Yep.
We got that. It's going to be more manufacturing and employment this week.
Yeah. Well, in the minutes, just remember that could be a market mover still, as we've seen in the past. So, all right, you guys have a good one, and catch you. Have a good week.
Good luck. Thanks.